Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone. We've just released our monthly India market outlook titled Can the Uptrend Sustain? In this episode, we discuss our macro and key asset class views. We expect India's economic growth to recover from the cyclical slowdown and stay ahead of its major peers in the year 2025. A likely recovery in rural demand and urban consumption driven by the sizable income tax cut in the union budget for fiscal 2026 could likely offset the impact from US tariffs and a slowing global growth. India's medium-term outlook remains robust on continuity of past policy measures, which include greater public capex spend, structural reforms, and incentives to boost manufacturing and infrastructure. Inflation could remain anchored to the RBI's medium-term target, driven by lower crude oil prices, modest food article price pressures, and prospects of higher agricultural produce amid better sowing and likely government policy interventions to manage supply-side concerns if they arise. Key risks, however, to a macro outlook are persistent high inflation, Trump's policies and global trade disruption, and escalating geopolitical tensions. Coming to bonds, stay neutral as attractive absolute yields are counterbalanced by below-average yield premiums. Improving bond-demand supply balance given lower government net borrowing, robust tax collections, and Indian bonds inclusion in the global bond indices are tailwind for bonds. In our assessment, the RBI has room to further cut rates amid muted inflationary pressures and a challenging global environment, with the possibility of an additional 50 basis points rate cuts likely. Lower policy rates, coupled with liquidity boosting measures, is likely to ensure better and orderly transmission of lower interest rates. We expect the 10-year government bond yield to trade in the range of 6.25 to 6.5% over the next 6 to 12 months. Within bonds, we are overweight medium and long maturity bonds, given potential for higher price gains as bond yields fall. We prefer corporate bonds, especially the high-quality AAA rated bonds, given cyclically high credit spreads amid stable corporate profitability. On equities, we stay overweight and expected to outperform other traditional assets. A likely recovery in domestic growth and earnings, easing financial conditions, better valuation relative to bonds, robust domestic investor flows are key drivers supporting a positive view. We expect volatility to remain elevated in the near term as investors assess the economic and earnings impact of US reciprocal trade tariffs. Within equities, we are overweight large cap equities given higher margin of safety in terms of earnings and valuations. In a sector strategy, we prefer domestic cyclicals and retain an overweight on financials and consumer discretionary. We upgrade healthcare to overweight and downgrade information technology to an underweight. Cash remains underweight as we see rising reinvestment risks as bond yields decline further. Gold continues to remain neutral. We see it as a strong portfolio hedge against uncertainty and stagflation worries. That's it in this edition. Thank you as always for listening. Do reach out to your relationship manager for a copy of our India Market Outlook. You can also find it on our website at www.sc.com/in at the SC Invest section. You will also find it on the Standard Chartered Market View on the Go page for India. Thanks very much.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.sc.com/in.